Hey guys, and welcome to today's video. So in today's video we're going to be discussing support and resistance institutional secrets. We're going to be looking at the way institutional traders trade support and resistance, and I believe by the end of today's video you'll be learning a whole lot to improve your trading and help you make better trading decisions. So moving forward, we're going to be looking um, at the following support and resistance ideas, the common ones we know. Then what lands well for S and R, that's support and resistance for those of you who don't know the short form. S and R is support and resistance for institutional traders. So we're going to look at what lands well for them. And we're going to be seeing some examples, of course, on the chart. And at the end of the day, we're going to be concluding this video rather. So without further ado, let's get into it. So support and resistance idea. The idea behind support resistance is simply an area of value in price where we expect to see price respect on the buy side or the sell side. So it's simply an area of value in price where we expect to see price respect. Either it can be on the buy side or on the sell side. So that's what support and resistance actually entails. Get so now when we look at support and resistance from a retail minded perspective, there are many things that comes to our mind, and let's take a look at a few of them. So the first one is the horizontal support and resistance. Like you can see on the chart, this is the pound dollar an hourly chart. You can see how this is the resistance area and below here is the support area right here. So this is one of the ideas of support and resistance from a retail minded perspective. So moving forward, the next idea of support and resistance is the moving average. Like you can see these areas shaded right here. So these are touches on the moving average. So the moving average you can see on the chart here is the 50 EMA moving average. So this is one way retail minded traders actually view support and resistance. So they plot the moving average on the chart to be able to tell them when to be a buyer or a seller. You can see those shaded areas on the chart are actually entry points where you can either enter a buy or a sell in the marketplace. So the next idea when it comes to retail minded perspective of viewing support and resistance will be the trend line. As you can see right here, this is a trend line to the downside, and this is a trend line to the upside, and another trend line also to the upside right here. So these are how retail minded traders will actually view support and resistance, because they want to take they want to see two touches, you understand, and they'll wait for the third touch, they sell to the downside, and obviously there's a fourth touch too that will also be a very good entry point. Why, if they're anticipating a buy move, they want to see one, two, then the third touch is going to be what they're expecting to go long on, or they want to see one, two, and they're expecting price to drop into this area and extend to the upside. So this is how retail minded traders will view support and resistance, and practically almost everyone person in the trading industry long before smart money will view support and resistance. So now, what's the problem with the above ideas of viewing support and resistance? The truth is that there is nothing, as long as you understand them and the application and how to use them. So there's nothing wrong with those ideas, whether using the moving average, whether using the trend line, or whether using the horizontal support and resistance. As long as you understand the application, how to apply them on your chart, and you understand how to use them. But you can see the big red but right there. But they are very subjective. You understand? They are very subjective. In other words, they are very, very dependent on price. You understand? They are not objective in nature. They make your trading more subjective than being objective. The second thing is that they are prone to cherry picking, like you can see on the trend line chart. You see how we're trying to pick for buy side objectives. We had to draw through two trend lines. You have to cherry pick points. You know what I'm saying? So they are very prone to cherry picking. You tend to cherry pick a lot of the times. You know, especially also when you're plotting your moving average. Should I plot and use the 20 EMA? Should I use the 50 EMA? Should I use the 100? So there's a lot of cherry picking. So, and you don't want to be trading with that kind of randomness in the marketplace. You want to be trading with great precision, great confidence, great degree of excellence and perfection, at least not 100%, but at least 90 to 99.9% of perfection and excellence. You get what I'm saying? Something that is stable, something that is constant, that you can go in price and see over and over again. You don't want to see anything cherry picking. You don't want randomness in your trading. So because if you have randomness in your trading, that means your results will be random. You can be a winner in one day and be a losers for the rest of the year. So you don't want that kind of trading. You get it? So moving forward is that they are prone to false signals and indications. In other words, they are open. You get? They are inclined to give us false signals and indications. You get, like you can see on the moving average chart. You want to say those, there were some points in those moving average charts that you could see false signals. You get it now. Even on the drawing the trend line too, you could also see that if you had um been dogmat on your trend line, you would have actually getting some false signals. You understand? Because of these indicators are actually subjective. This approach is actually subjective in price. So you don't want to be actually just trading them as a solution unless you understand the application and how to apply them. So the last of all, I believe, should be they are prone to analysis paralysis. In other words, they don't help you arrive at that trading decisions. You want to say as quick as possible. This moment you're seeing a buy, that other moment you're seeing a sell. Like you can see on that trend line chart that we had, you could see when the trend line crossed from the buy side and from the sell side, you can see how price started squeezing in between. So at that point, there's a lot of indecision. Should I be a buyer? Should I be a seller? You got what I'm saying? So they are prone to analysis paralysis. So you must understand that and how it applies to you. But as long as you understand them and the application and how to use them, there is no problem. So what lands well for S&R for institutional traders? Like, how does institutions view support and resistance? What is their secrets of approaching the marketplace in terms of support and resistance? Number one is liquidity. We want to say the number one key for support and resistance for institutional minded trader is liquidity. You want to say this is how they view support and resistance area in price. Number one, liquidity. The second is imbalance. They view first liquidity, second imbalance. The third is pending orders. Where are pending orders? Where are the pending orders rather in the marketplace? You want to say first of all liquidity, second of all imbalance, third where are pending orders in the marketplace, and the last of all is open orders. And I know some of you be like, I know pending order, but what's open orders? Don't worry, I'm going to get a deep dive. I'm going to explain each of these ones one at a time. So these are the four things that the institutions look for when viewing support and resistance. This is how they arrive at support and resistance area in the marketplace, and this is where how they key off their buys orders out their sell orders. So let's explain the first one. The first one is liquidity. So when we talk about liquidity, it's simply buys and sell stops area. In other words, old highs, old lows, series of highs or series of lows. These are areas of liquidity. You understand? Because that's an area of open float. You understand? So they want to go there because they know that there are buy stops and sell stops residing above those areas. So that is how they view liquidity. You understand? So that's what liquidity is all about. The second is imbalance. And when we talk about imbalance, we're talking about the fair value gap and the liquidity void. You understand? So this is how they view the imbalance in terms of support and resistance. They're looking for areas of fair value gap or areas of liquidity or where price rally aggressively in only one direction without trading efficiently for a period of time. So the next area of support and resistance is the pending orders. And when we talk about pending orders, we're simply referring to the order block. But now the class of order block we're actually referring to is the breakout block. You understand? So in terms of the breakout block, they are seeing pending orders at that particular area. You understand? They are pending orders residing at those areas, so they are coming back to those areas to actually get those pending order activated in the marketplace, or actually okay, I believe that'll be the next one, which is the open order. So we're going to see, and this particular one is still the same thing as the order block, but now they're looking at the mitigation block in this particular context. So they're actually returning back to that mitigation block to actually mitigate their orders in the marketplace. So these are the four ways institutional traders view support and resistance. So any other thing apart from these four ways, you want to say, is retail minded perspective. You want to say these are the four ways that they actually view support and resistance. So let's see some examples. I believe every one of us want to do that. So let's get right into the chart. So here we are on the chart, and this is the dollar index chart on the weekly time frame. So I'm going to be using the weekly time frame chart, but the approach is the same across all time frames. But to make this example, because I want to give a plethora of examples, so to make the example quick and easy, that's why I'm actually using the weekly chart. But you can actually do this on any time frame of your choice, whether be it the 1 minute chart, the 5 minute chart, the 15 minute chart. Go in there and see it for yourself, but just follow the same approach, the way I'm looking at it, and you're going to arrive at the same result. So I want to do 2 years worth of data. So I'm going to be starting from 2021 on this particular period right here. So let me bring the period, this thing here, so the vertical line rather. So I have that right there. So if I zoom that in, so this is the way they approach it right here. So they look at swing ranges. So this is a swing high going into this year 2020, 2021 rather. So this particular swing high is what a old high. So this is an area of liquidity. So this is a resistance level if price is to trade to the upside. So this is what they're going to do. They're going to take this place from this high and all the way down to the body of that particular so from this particular high to this area where the body of the candles are. So this area now is a whole area of resistance. Now to the downside, you can see there's also a swing too, so we're going to take that also into account right there, the entire from the body down to the weak end. So I'll bring the vertical line. So because of time, I'm going to try and speed up a lot of process. So if we look at the at the at the daily chart, you can see when price trade into this area, zone, this zone right here, which is just above the body of the weekly time frame liquidity area. You can see the way price rejected. So this is a confirmation candle right here, another block. So this can be an entry for you. Why are you targeting? You're targeting either this zone right here or automatically these lows right here. So these are the institutions who actually trade this whole sell to the downside. And if you look right here, you can see the degree of move to the downside. So this will tell you that there's an institutional sponsorship behind this move to the downside. So this is how the institutions will actually view support and resistance in a particular area like this. So the next thing we're going to do, we're going to go back. Let's look for more examples. Let's do more examples. So if I'm to still stay around this area, we can see that after this area of price action right here, we can see that we have double tops. But mind you, this high has not been cleared, so this is still an area of liquidity acting as a resistance for us right here. And these double tops here are also an area of resistance for us, which is an area of liquidity. And right now we already have a swing right here, so I'm going to take that into account. This whole swing right here, I'm going to take into account from the body to the end of the week. So we're going to take that into account. So price drops into here and start rallying up. So we want to see the way price rejects above here and use that as an entry for us. So on the daily chart, we can see price weak through these double tops right here. So on this other block, this candle to the inside it, that will be our entry to the downside. And if you look right here from this low to this particular area, this is a fair value gap, an imbalance on the daily chart. So you can enter here and exit here. So this is also what is a support area in price. Is a support area in price. But mind you, if you go on the weekly charts, you can see that this is actually a mean threshold of this order block right here. The mean threshold of this order block and also a liquidity area. So you can see the way price bounce off it, aiming back at that area of liquidity right there. So this is classic support and resistance for institutional minded traders. So this is how institutions actually view support and resistance. They key off areas of liquidities, you want to say to area of imbalance. Like now you can see our price drop into this area. This is an area of imbalance on the daily charts. You can see that clearly. There's an area of imbalance right here. They fill in this imbalance, and you see the way they rejected up to where an area of liquidity right here. You can see the way they actually came into this particular area right here, an area of liquidity, just clearing above that area, and came down to an area of what, of liquidity. So the key of either from liquidity to liquidity, or from imbalance to liquidity, or from liquidity to imbalance. It depends, that and the cycle goes on and on. Then let's look for a breaker block example that we can use right here. Okay, I think I've seen an example. You can see this will move like this right here. So someone looking at this whole expansion to the upside will say this is an imbalance candle right here. This is an expansion impulsive price move. But price, before price gave this expansion, you can see price created a W shape pattern right here. So this whole move has a divergence to the downside, and this validates this particular area as a breakout block right here. So when price expanded, you can see the way price came back, reacted around this particular area upon all these blocks to the downside. So what did they have here? They have pending orders. You understand? They have pending orders right here to the downside. You understand? So what they did here, they triggered those pending orders right here, and you can see the expansion to the upside. You understand? They paired up those orders that they are right here, the pending orders. These are part of the pending orders they have right here, the orders that they were selling to the downside, and also the orders that they have also right here that they did not fill completely. You understand? So the orders that they stopped filling in around this area to the buy side, so they came in, triggered those pending orders right there, and also the ones they have right here, they mitigated that particular order. So two things happened right here: trigger of pending orders, and also a mitigation of orders that are already opened. You understand? So two things happened right here. You can see how price left the mitigation block and came forward area of liquidity above these highs, and you can see how price rejected here. So let me I think it's better I calibrate that so it will be clear. So price left this area of pending orders and went up, clearing these highs right here. And you can see the rejection above these highs, and this sold where down to this area of liquidity. So you can see it right here, selling down to this area of liquidity. So you can see the way price is just moving from breaker to liquidity, from liquidity to liquidity again, now from liquidity expansion, clearing out all this liquidity. And I'm sure if we zoom that out, we can see that this whole move went to where an imbalance right here. You can see the imbalance right here, an imbalance right here. This is what price came into view right there. So this is a fair value gap in price. So price left this liquidity and expanded all the way into where the imbalance. And you can see how price rejected from the imbalance. So a classic moving average approach, trend line approach, will not be able to predict this move accurately like this. You understand? A moving average, a trend line approach will not be able to predict this move as accurate as just focusing on these key areas. You understand? Liquidity, imbalance, pending orders, and open orders. You understand? You want to know where open orders are in the marketplace. You want to know where pending orders are in the marketplace. You want to understand where liquidities are in the marketplace. You want to understand where imbalances are in the marketplace, and this is what price will use for support and resistance for an institutional minded trader. So that's the way they're going to actually approach it. So one more example before I call it a day in this video. Let's look at this area right here. So you can see price expanded to the upside right here, and price is coming down right here. So you can see that this is what a fair value gap right there. So let's see how price reacts over that area. So this is an area of support for price. So price dropped into it, filled that void completely, and you can see the way price rally to the upside. And if you look just right here, this is actually also a breaker block we have right here. There's a pending order right there, and you can see the way price just came touching just above the candle right there on this move to the downside, and you can see the expansion to the upside all along. So this is how to approach support and resistance in the marketplace. And I can tell you, if you start applying this in your trading, this particular secret, this um bread and butter approach, your whole trading is going, your trading performance is going to skyrocket to the moon. So I hope you find value in today's video. If you do, hit the like button and subscribe to this channel for more videos like this, more content. If you don't understand anything in this video, you can leave your thoughts in the comment section. I'll be sure to answer. Maybe I went over something too fast, or maybe I went ahead of myself and I didn't explain something properly. Just comment that there, and I'm going to practically explain it to you through the chat on the comment section. So thank you very much, and see you in another video.